Bloomberg Audio Studios. Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's switch gears to logistics transportation. UPS still having some challenges. The UPS misses profit estimates amid heavy costs and uneven demand. Can't catch a break. Stock down double digits here. Lee Klaskow joins us, Senior Transport, Logistics, and Shipping Analyst for Bloomberg Intelligence. Lee, again, another tough quarter for UPS. What's the story there?
I think it's a lot of things. They are seeing volume growth, which is good, but that mix of growth is not good. What they're seeing is their shippers trading down. So if you were going to maybe send something via air, maybe you decide to go on the ground, which is, cheaper and lower margin. And then if you're using ground, maybe you're going to use one of their products like SurePost, which is like an economy product, which is cheaper and again, lower margin business. So you are seeing, folks trading down. You're also seeing the mix of B to B2C outpacing growth of B2B. B2C growth was around 4% and B2B growth was down 4%. And B2B, so think like a lawyer sending documents to another lawyer's office. That business tends to have better margins because of the inherent density that follows that business. And density is really good for asset-intensive networks like UPS's. And then you also, have another negative mixed impact. You had two, they called out on their call, two large e-commerce companies. I'm assuming that, these are companies out of China that are, are kind of using more economy services. So you're seeing a surge in that demand from there, as well as addition to the trade down trade that that I mentioned earlier.
Is this the trough? Is this sort of the worst it's going to get?
It's a great question. I mean, I think so. I think it feels like this is the worst. I mean, the company has done pretty well in terms of meeting expectations or beating expectations. This is the first miss since I believe the first quarter of 2020. So, Carol Tomei and her team have been on quite a roll. They also have some easier comparisons going into the second half. Some of your listeners might have remembered they had a really, tough negotiation with their labor unions. They had a new contract that was really, heavily weighted in the first year. That gets anniversaried in August 1st. So therefore, those higher labor costs, the comparables will ease significantly, after August 1st. So that should provide a better cost for them in the third quarter and going forward. Also, peak season's here, right? A lot of the companies that we cover are talking about most of them are expecting a real peak season. And we're not talking about, the peak seasons that we've seen in the 1990s or early 2000s, but you're definitely going to see seasonal increase in demand. And that peak season is one of the shortest on record. It's around 17 days between Thanksgiving and Christmas. And that will allow UPS to implement surcharges because they're going to have to, get those resources in a short amount of time to make sure that, they're able to deliver at high service levels. So you should see probably some good some good demand, revenue growth in the fourth quarter from those surcharges. So, that coupled with a lot of their cost-cutting measurements, they've reduced a lot of heads. I think a lot of things are going to turn for this company once you're going to see, that B2B volume return. And the company is doing a lot of things, I think, to position itself longer term, whether that's, focusing on the healthcare logistics. Obviously, there's a lot of value add there, and those margins are pretty high relative to, someone throwing a package on your porch. And so, they're really looking to grow that business, and they want to be a leader in that business. And to be frank, it's a fantastic business to be in if you're a logistics provider. And then, they're also trying to do new things with, or more things, I should say, with what we call SMBs, which are small, medium-sized businesses. That tends to have better margins than, dealing with these super large companies like Amazon, which, the business is good, but the margins could be better.
Right. I have absolutely no loyalty between these two companies. I mean, I have actually no loyalty between these two services. I mean, the FedEx store and the UPS store are kind of right next to each other in my little strip mall. So whichever's got the shorter line, that's kind of where I go. But boy, you look at the stocks over the last 5 years, UPS is up about 7% per year. FedEx is up almost 14%, so twice the stock price performance. So Lee, from an investor perspective, you got 30 seconds here. What's the difference between these two companies from an investor perspective?
Well, it's interesting. So like on FedEx, I think they're dealing with more structural issues because that was a company that I would say was extremely bloated, over the last decade, and they're kind of right-sizing their network. They're both making changes to their networks to kind of meet the new demands, that change of increase in the home delivery versus, delivering to lawyers or doctors' offices or corporations. I think the biggest difference is, there might be more margin expansion opportunity at FedEx just because they're starting from a lower base than UPS. But these are two what I would consider blue chip companies that are, should benefit with the economy, and they should probably be able to grow top line well past global GDP, just given some of the self-help things that they have in front of them.
All right, Haley, super appreciate it. Thank you so much, Lee Klaskow. He joins us from Bloomberg Intelligence. He covers all the logistics and transportation stuff for us.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix alongside Paul Sweeney and John Tucker. Yeah, crude really getting hit by weaker China demand. And we're going to talk about that in the next hour. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, politics, and finance. We are broadcasting to you live from the Interactive Broker Studio right here in rainy Midtown Manhattan. The latest news on the political front is Kamala Harris now has more than enough pledged delegates to clinch the Democratic presidential nomination after just a 2-day blitz that saw the vice president consolidate her party's backing to challenge Donald Trump in November. Want to get more details on all of this with Henrietta Treyz, managing partner and director of economic policy at Veda Partners. Henrietta, now what happens? What does pledged delegates mean?
Well, the pledged delegates basically means that the field is clear for Kamala Harris. She will be the Democratic nominee as expected. We will get that confirmed around August 7th. They're going to start virtual roll call voting at the DNC in the beginning of August and carry through until about the 7th when it'll become relatively official. And then we will have the convention on the 19th. Around then, we should get to understand who her vice presidential pick is. So it's really all eyes on Democrats for the foreseeable future.
Henrietta, can you give us a sense of the timing associated with the VP pick? Is there any rush to get it done sooner rather than later as it relates to maybe that virtual roll call?
No, not really. And based on what we're seeing from the Democratic Party right now, and I would think back to, how long it took for President Biden to come to the conclusion that he was going to step aside, the slow approach that Speaker Emeritus Nancy Pelosi took to President Biden, the slow approach that the donors took. This is all orchestrated, not, necessarily on purpose, but designed to keep the attention on the democratic process that's playing out in the Democratic Party. Make sure that they're vetting a lot of these guys, the people that they're considering, the governors from the swing states, Mark Kelly in Arizona. These are folks that have very low name recognition outside of their state. So a lot of the vetting process is being done in real time. We're watching it all unfold. And I think it's going to take the remainder of this month and into the beginning of next month. Let's recall that former President Trump announced his VP pick on the Monday of his convention. I wouldn't be surprised if that's the side of timing that we get on the Democratic side as well, which means we've got another couple weeks before we know for sure who it's going to be.
We also keep hearing, these rumors that Republicans are talking about, we're hijacking democracy here. This is not democratic, which leads me to think, are we going to see lawsuits in relation to Kamala Harris being on the ballot? Are we going to see lawsuits concerning the campaign funds? Are we going to see lawsuits preventing her from getting on the ballot in certain states? Is all of this just talking points, or is any of this real?
No, these are all relatively frivolous lawsuits. The Democratic Party has until the convention to name a nominee. Once they do, I think the concerns around the democratic process are what you're seeing in terms of slow walking endorsements from former President Obama, from Majority Leader Schumer, from Minority Leader Hakeem Jeffries. This is Democrats trying to explain to American voters through illustration that they're going to take their time and not necessarily have an anointment of Kamala Harris. They chose the direction that I think was the only conceivable conclusion, which was that Kamala Harris, the current vice president, who, millions of people have already voted for to go into the White House, is going to be at the top of the ticket. And the endorsement from President Biden really sealed that when he wrote his letter over the weekend. So I think that the direction we're getting from the Democratic Party is clearly indicative of Kamala Harris winning the delegation. There was no real primary, but the process has, been playing out for so long now, even though it's only been a couple of weeks. It feels like an eternity. And I think the Democratic voters, as evidenced by their fundraising numbers, are clearly enthusiastic and happy to have Kamala at the top. There was some morning consult polling that came out this morning showing that Democrats prefer her to be at the top of the ticket. Pete Buttigieg was next in line, but she clearly wins the majority of the Democratic voters. So I don't think there will be an uprising against Kamala from the Democratic voter base.
And let's talk money. I'm just reading your notes here. I mean, like $81 million was raised just in the 24 hours after President Biden endorsed VP Harris here. Give us a sense of the magnitude of the fundraising and what it tells you, I guess, about her candidacy and the support of the Democratic Party.
Man, I mean, the numbers are staggering in and of themselves. They broke Democratic records, presidential records for a 24-hour haul. She's up over $101 million as of right now. But the real data set is the fact that 60% of those donors are new to the 2024 cycle. That is grassroots engagement, momentum, on par with, if not exceeding, what you see on the Republican side in terms of galvanization from Trump supporters. One of the reasons that my odds are 60-40 for Trump right now is because we don't have any hard data from polling to suggest that Kamala Harris has a shot to win in the swing states yet. But the fundraising numbers and the heat map that you see from the Act Blue campaign suggests that those same states that Kamala Harris would need to win are the ones that are donating amongst the highest amounts.
What do you think is going to wind up happening? Like, how do you game out now? Like, what happens in November and beyond? I mean, moving sort of money into any kind of asset class to bet on it now seems crazy. How do you think about it?
I really think that investors should focus on the momentum play. That is the main focus of my note from last night. The momentum story has been with the Republican Party on things that were planned and unplanned. Obviously, Trump winning the first presidential debate, getting a failed assassination attempt was extraordinarily galvanizing. I think it's insane that, that's not the number one news story of the day. But the reality is, and I talk about this with clients a lot, the Republican momentum came and is now gone. And now it's all with the Democratic Party. And of course, it would be ridiculous to assume in 2024 that there won't be another wrench thrown in the gears here. But for right now and for the remainder of this month and next month going into the DNC, we haven't even gotten to those events yet. So not only is the Democratic Party galvanized in a new way that we haven't seen for 2 years, but the groundswell of support, the pent-up demand is so robust that I suspect it will compel Kamala Harris well into August and then into the critical months and the final countdown of the election into mid-September. What's fascinating is 24% of independents don't decide how they're going to vote until after Labor Day, historically. Yep. So even though we're only 100 days out from the election, there's a shockingly large amount of time still left in this race.
What do you think the debate strategy should be for Kamala Harris and the former President Bush? Trump.
We can't go back that far. I think at this point, you just got to get Trump to the stage. I think that if you read his Truth Social pronouncements, he is really definitely attempting to move the needle on the debates. And the question is really whether he shows or not. I don't think it's optically possible for him not to debate the vice president and the ultimate Democratic nominee. That debate is tentatively set for September 10th. Kamala Harris, when she was vice president, has set a couple of dates, the 12th and 13th, if I'm not mistaken, of September for a vice presidential debate. But the Republican ticket hasn't committed to any of those. I think the American public is going to demand the Trump debate Kamala Harris, and I think it would be a material show of weakness if he did it.
Just some breaking news for us, confirmed by AP as well as ABC News. The Secret Service Director, Kim Cheadle, has now resigned. This comes, of course, after the attempted assassination attempt on former President Trump's life. Henrietta, are you surprised by that news?
Not really. I'm surprised that it lasted as long as it did. The Secret Service has come under fire for years now. And I think in the wake of the attempted assassination attempt, which was so shocking to so many Americans, we haven't seen that, in my lifetime, it is really something that required a shakeup at the top. The Republican Party has come out very strongly against her and has been very focused on the Secret Service. There are investigations that they're waiting for with a couple different deadlines, 60 days out from now, for a thorough accounting of what went on. It makes sense that she would resign.
Henrietta Treyz, thank you so much. We really appreciate it. As always, Henrietta Treyz, she's a managing partner and director of economic policy at Veda Partners, really one of our go-to voices on all things political. And I think we're going to be talking to her very frequently between now and Election Day, because as Henrietta said, there's bound to be more wrenches thrown into the whole process.
And then as an investor, what do you do? Gina Martin Adams of Bloomberg Intelligence had a great point that said that high tax companies have underperformed low tax companies. And if you were betting on President Trump, you would probably buy high tax companies with the idea that those would be cut, that those taxes would be cut. Therefore, maybe what we're seeing in the market isn't based on the election, but on earnings and fundamentals, which brings us full circle back to a day where we get almost $6 trillion of market cap earnings coming out.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's switch gears and let's get right to the media space. So we have some media companies reporting. We're also going to have Google reporting after the close tonight. Geetha Ranganathan joins us. She is the media analyst for Bloomberg Intelligence. Geetha, I know we had Comcast today and that stock's trading down, but let's go with a winner, a good story. Spotify. Now, I'm not a Spotify customer per se. I'm going to venture that John Tucker neither is probably not a Spotify.
No, because he has his cassette tapes.
He has his cassette tapes. Very good.
No, I just refuse to pay for it when I can get it free.
You know you have cassette tapes.
Okay.
Exactly.
Guilty.
Do you?
Yes.
Yeah!
Very good.
I have 8-track tapes.
I have 8-track tapes.
And this is why we love you.
That's exactly. Geetha, talk to us about Spotify. Stock's really rallying today.
Yeah, thank you so much, Paul and Alix. So Spotify really blew it out of the park. You're absolutely right. They're up, I think, now 13, 14%. And really the number here for Spotify and the main story has not just been great subscriber growth. So they've been adding a solid 5, 6, 7 million premium subscribers every quarter. But for them, what it really has been over the past few quarters has been this inflection in profitability. Remember, what we're now looking for streamers across the board, and this goes to Netflix and everybody else in video streaming, as well as Spotify, which is the main audio streamer with a 35% market share. The narrative has really shifted now to profitability, and they absolutely blew it out of the park. So the gross margin guidance that they had given was 28%. They came in at 29%, but even better was the outlook. So for the longest time, Spotify was stuck at like a 25% gross margin. They were pointing to like longer term margins of 30%, but looks like they're going to be able to hit it right in the third quarter. And that's why we see the stock reacting the way that it is.
So did it take anyone else's lunch, or this was just a really good sort of management cost issue?
Yeah, it's excellent management. More importantly, it's also price increases. They've done, they hadn't taken any price increase, Alix, for more than 10 years. And then in a span of two years, they've raised prices by 20%. And that's just because they know that people love Spotify. Nobody's going to churn from Spotify to, let's say, Apple Music or YouTube Music. They have a 36, 37% share of the global audio market. And they're just adding so many features and so many new verticals that they're able to take those price increases. But of course, apart from that, it's also been a very good story when it comes to cost cuts. So they were investing heavily in their podcasting business, like with the Joe Rogan show and adding all these other exclusive podcasts. They're being much more prudent now on that front. And those cost cuts, again, have really driven profitability.
How much of their revenue is subscription versus advertising versus other these days?
Almost all of their revenue, Paul, is subscription.
Ooh,
so
it's
it's
nice.
It's a very, very heavy subscription-based business. They are trying to build the advertising business, but as you know, again, that takes time. That will drive the longer-term margin story, but as of right now, the mix shift is really subscriptions.
That's pretty impressive. Hey, can I ask you about Comcast and what you made of their earnings that came out earlier, reported second quarter revenue that missed analyst estimates? It was the movie season, you got theme parks, the whole thing.
Yeah, so Comcast is an interesting story. So Comcast is actually, your typical media conglomerate. They own both video distribution, broadband connectivity, as well as the media side of the business with NBC. 80% of their EBITDA actually is related to just broadband subscriptions. And so what happened this quarter, we were expecting a little bit of softness in broadband. And as expected, yes, they did lose subscribers. Remember, the whole cable industry is really in a slump because of very, very intense competition from some of the telecom offerings, both with fiber and fixed wireless access. So we're kind of seeing that slump, and it looks like Comcast is really not going to be able to get out of that slump. More interestingly, however, for both Comcast as well as Disney, is that the theme park attendance is actually flailing, and a 24% decline in their theme park EBITDA. And that's really because huge pull forward, or what they're saying was a huge pull forward post-COVID, and now we're kind of seeing normalization. So that was a little bit of a disappointment. But I think overall the business is fine, but we are going to see some extended softness over the next few quarters.
And, the stock is down about almost 6% today, down 15% year to date. When you look at Comcast, great collection of assets, but none of which are really, they're all facing serious headwinds. What's the feeling among analysts and investors you talk to? Like, what can a Comcast actually do to become, an attractive stock?
So Comcast, of course, Paul, as you well know, it's always kind of been saddled by this conglomerate discount. The big question, and we know Brian Roberts has always been hungry for some kind of deals. So the wild card, they're obviously a wild card when it comes to M&A. I guess once, if the administration changes and if it's more favorable for deals, I think Comcast will be a major player. We don't know whether they'll look to do some kind of joint venture with, Warner Brothers or Fox. It remains to be seen, but of course they will be a major player in the space. Again, in terms of what would move their stock, maybe if they spin off their NBC business. Brian Roberts has not indicated any such thing, but I think over the near term, what really needs to happen to kind of move the sentiment on the stock is they have to show positive broadband subscriber growth.
All right, Geetha, great stuff, great analysis as always. Geetha Ranganathan, she covers all the media business for Bloomberg Intelligence. She's down in our Princeton office, and you kind of look at those two stocks, Spotify, kind of the new media, if you will, Comcast, kind of the old media, if you will. When there's a time when I was covering Comcast, it was the new media versus some of the traditional media, like newspapers, magazines, that kind of thing. But it's just this evolution and what technology has wrought to the entertainment and communications businesses. A lot of these traditional media companies have a really hard time kind of evolving.
Yeah, and then how do you break it up when one area is your revenue stream, but the other area is your growth? I'm glad I'm not in their shoes.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's go to energy for a moment. There's a couple different threads here that we kind of want to unravel here. Oil is trading a little heavy again, down by almost 2%. We're now at $76.98 on WTI. Chris Wright is CEO of Liberty Energy. He's very outspoken when it comes to how he thinks oil policy should be, and we love that about him. Chris, we're going to get to that in a moment, but I wanted to understand what's happening with crude. It's had a real meltdown over the last couple of weeks, along with copper, along with aluminum and nickel and iron ore. What is this telling us right now?
Alex, I think it's fear of slowing economic growth ahead of us. Look, China's the biggest buyer of hard commodities. They're by far the biggest importer of oil. They're building big strategic storage reserves for all commodities, including oil. And so in China, you saw us cut interest rates recently. People are fearful of Chinese economic growth. If they slow down, that marginal buyer of oil and iron ore and copper is going to pull back a little bit. So oil prices are still around $80. I don't think they're in a bad place, but I think fear about economic growth and specifically fear about China is probably the cause of that.
Hey, Chris, in case you didn't notice out there in Montana, but this is an election year. What is the energy industry? Oh. What do you and your energy industry pals, what do you think about, Republican versus a Democratic administration here as it relates to your industry?
Look, I've been outspoken on my visits to Washington that the efforts of the current administration to make it harder to get a drilling permit or to get a pipeline or to drill on these lands, what does that do in effect? It just means we produce a little less oil and natural gas. It doesn't change demand at all. So it just pushes prices up. So look, our industry's been at record profitability. That's great for me. That's great for our industry, but that's not great for our country. If you have higher prices, it just makes people's lives a little bit tougher. And nothing the government does really impacts demand. Demand for hydrocarbons has grown at 1.6% compound annual growth rate for 50 years, a little faster than that in the last decade or two. So the presidents are not going to impact demand, but they are going to impact how much of that's produced in the United States and how much of that's produced overseas.
So here's my thing with that I don't quite understand, is that oil production in the U.S. is at a record high. It's higher than it was when President Trump was in office. So what's the problem?
It would be higher. But you're right. You're right. Look, most of the production's on private lands here, so that there's still room to grow production. We are at record high. We'll continue to set record highs probably for another couple decades. The question's the pace at which U.S. production grows, and how does that compare to growth in global oil demand, which is a little 1 to 1.5 million barrels a day. During the boom years of the shale revolution, the U.S. production were growing as fast as global demand. That really keeps oil prices down. If U.S. oil production goes much slower than global oil demand, so other countries have to meet those incremental barrels, that's an upward push on prices. Good for our industry, but not necessarily great for the country.
Where are we as an industry in terms of the fracking evolution, if you will? Because it was such an amazing story to turn this country from a net importer to a net exporter. Where are we in that process?
I would say midstream, mid-innings. There's still a lot of technology improvement going on, but the low-hanging fruit in the first couple decades, most of that's been picked. So the rise in productivity is much slower these days. We're still getting better at making each well better, but of course you drill the best locations first. The rocks and oil, that give up oil and gas the easiest, most of those have been drilled. So we're drilling slightly lower quality rock, and we're trying to offset that by improving fracking technology. For many years, fracking technology outleaped the decline in rock quality. Now you're seeing a slight decline in the productivity of each well because that degradation in rock quality is running a little faster than technology. But, not a huge change. Mm-hmm. A lot of room to run for U.S. production.
So, Chris, if President Trump gets in the White House and he opens up all federal land to drilling, really sort of opens up things in Alaska, et cetera, if that really invites more production, then won't the oil price fall even more, which then doesn't that hurt the break even? So there's got to be some kind of middle ground.
Exactly. Look, the markets always find a balance. But there's no question, a Trump administration would make it easier to produce U.S. oil and gas. So our production would grow. You'd see some offsetting factors, though. We'd see faster permitting on LNG export terminals. So the U.S. exports of natural gas would grow. I think you'd likely also see more industry relocated in the United States. Like, our natural gas resources in this country are just awesome. But yet most of the energy intensive manufacturing, think steel and cement and solar panels, that's done in China, and that's powered by coal. If you brought more of that industry back to the U.S., it would be powered by U.S. natural gas. You'd see lower air pollutant, lower greenhouse gas emissions, and more American jobs. So the Trump administration would certainly lead to more growth in U.S. oil and natural gas production, but it might also lead to more consumption, more domestic consumption of those products as well.
Chris, I'm looking at your balance sheet here. I'm not an industry analyst for energy. It looks really conservative to me. $460-70 billion of total debt. You got $1 billion of EBITDA, free cash flow positive. What do you do with that kind of dry powder, if you will?
Are you investment banker pitching him right now?
I am, because I'm thinking about I could do a lot of stuff with this balance sheet.
So, Chris, just so you know, Paul is a former investment banker for media. So, just set you up there.
I appreciate that, Paul. But yeah, we always keep a conservative balance sheet because, look, our industry is very cyclical. We've had 2 violent downturns that have both been opportunities for us to buy distressed but good companies at cheap prices. So we're always ready for a downturn to be aggressive. And also, you're seeing a degradation in the U.S. electricity market. Electricity is becoming more expensive and less reliable. That's very unfortunate for our country, another one of those bad energy policies. But it's an opportunity for Liberty to start selling electricity into the grid. We power our frac fleets, burning natural gas to generate electricity to power frac fleets. We can take that same electricity and sell it to data centers or towns that are struggling with an unstable grid. So I think you're going to see a broadening of the shoulders of Liberty's business, and we're going to deploy a lot of our excess cash flow into a new business line, and we'll continue to buy back our stock, of course. We still trade at a single-digit price-to-earnings ratio.
Chris, that's actually tremendously interesting because sort of the conversation that was emerging at CERAWeek this last year was, do energy companies need to rethink the kind of company that they are? That they can't just be a straight up oil and gas producer. Do they have to sort of become power providers? And that's a different business. It's a different outlook. It's kind of rethinking the structure of what a business looks like. It sounds like you are deeper in those conversations than maybe some of your peers. Would that be true?
Yes, look, I think most will not, and most should not. Oil and gas is at an all-time record high market share for U.S. consumption. This sort of fears that oil and gas is going to be gone or demand will be gone in 20 or 30 years are just nonsense. So I don't think it's a necessary thing, but in our company, Liberty, we developed power production technologies, the highest thermal efficiency, meaning most of the energy from burning natural gas turns into electricity on the planet. So we have these mobile power plants we're using in the industry. We already developed that technology. Of course, we're going to go ahead and deploy it outside of the oil and gas industry.
Chris, do you have any appetite for being an acquirer of assets at this point?
Well, I would say we're mid-cycle, maybe a little below mid-cycle. We look at stuff all the time, but we only, we're mostly an organic builder. We only buy stuff if it's compelling. But, a different technology, a different business that maybe leveraged us faster into where we want to go, sure, we're open to that. We're always looking at opportunities.
And would that be in sort of the oil space to ramp up current positions? Would it be more to acquire some new technology, since we already talked about how current wells, not tapped out, but they're nearing that top out cycle? Would it be more natural gas? Would it be infrastructure? Would it be power?
Power is certainly a possibility. We're going that direction anyway. Might we buy a smaller player to speed that entry? That's a real possibility. Technology is something we always look at. We frack 20% of all the wells drilled in the U.S. and Canada. So, we're not really going to acquire to get market share. We're already the biggest, and I would say by a fair margin, the highest ranked quality provider in our space. So probably not in our core business, but certainly in peripheral businesses is possible.
All right, Chris, thanks so much for joining us. Really appreciate getting some of your time. Chris Wright, he's the CEO and chairman of the board of Liberty Energy. That's a publicly traded company. LBRT is the ticker. Stock's up about 15% year to date. So putting in some decent numbers. Got about equal number of buys versus holds on Wall Street. So the street's kind of mixed on that, which is probably true for energy in general.
Yeah. Also, see, here's the interesting part is that if you're a portfolio manager or a big investor, you can't own a lot of energy stocks. Like, you really can't anymore. So you have to really pick and choose which ones you're going to buy, which means the bigger have to get bigger. The mediums definitely have to get bigger. You have to really appeal to shareholders of why you're that one stock, which is why I also thought that his information about power was interesting too, because that's a totally different type type of company, in a different business line, and who would be good at that and who would not be. And that was definitely part of the conversation. Do these guys really need to rethink who they are fundamentally?
Right, and at $3.5 billion in market cap, are you a natural buyer of more assets or seller? And he says they're already roughly 20% of the fracking in this country, so probably not going to get much bigger in that line of business. So interesting to keep an eye on that company based in Texas. Based in Denver, Colorado, actually.
There you go. You're in Colorado.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Boy, you look at Tesla, they're reporting after the close tonight. Stock year to date is absolutely unchanged, but that does not tell the story. I mean, through kind of the end of April, that stock had declined 50%. But since then, it's up 75%. So go figure. I think the market's trying to figure out what this company is here. Kevin Tynan, he knows. He's been covering the auto industry for decades. He's director of research at Presidio Group. Kevin, what are you looking for after the close here today when Tesla reports? It's kind of a mystery.
Yeah, well, the good thing, Paul, is that their throughput was above 100%, meaning they sold more than they produced for the first time in several quarters. And what that does is it helps margins essentially. So what you've had is a lot of output, difficulty selling it, and that's very, that you're paying your cost of goods, but you're not booking any of that revenue as a direct seller. So what Tesla and all the direct seller and pure play EV companies need to do is to distribute everything that they produce. And that's been a problem. But most of them, or all three, Rivian, Lucid, and Tesla, were able to do it in the second quarter. Now, the way they get there is by cutting production. So while it helps in terms of cost of goods, revenue, your income statement, and even your balance sheet, because you're not carrying that inventory, as a growth company and trying to ramp your output, you're actually taking a step back. And I think Tesla's production in the second quarter was actually the lowest it's been since the third quarter of 2022. So tightening up the throughput, but at much lower production rates.
What is the main thing that I'm supposed to care about in earnings? So you're mentioning production and throughput rate. Then there's like AI stuff. It's trying to position itself as an AI company. There's robots that are going to make cars. There may be a robot that's going to drive a car. I mean, I'm legit confused as to what the multiple is trading on and what I should care about come 405.
Right. Well, that's exactly what you're supposed to think is as an automaker, right? Right, you're cutting production. So Tesla has the ability to distract in that way, to say, hey, there's all these other great things coming. We're not simply a metal bending automaker like everybody else is. We can do these other things. And that's what our valuation is based on. Because as an automaker, again, you're in this cycle where inventory is getting very frothy and you need to cut production. Well, now you're not a growth company, but you're not an automaker either, right? So you can point to these non-disprovables such as the robotaxi business or full self-driving or whatever else is down the road that you can pin your valuation to that isn't really the nuts and bolts of auto manufacturing. And Ford, GM, Stellantis, basically everybody else doesn't have that benefit to distract to those other business units.
All right, you mentioned GM. The stock's down 6.7% today, but I thought that they're beat their numbers. So what's going on with General Motors?
Yeah, I mean, when you look at it, perhaps it's backing off the EV commitment a little bit. If you look at some of that Tesla valuation being tied to the EV market and most of the legacy automakers kind of taking at least a half step back or extending the timeline in that. But another one where GM's actually in a reasonably good spot, at least when you look at North America and the US, not oversupplied. They did increase production in the second quarter by about 8%. So looking into the third quarter, there may be a little bit of price issue profit margin issue because they are getting a little bit oversupplied, specifically in EVs. I looked at it just now, and there's about 150 days supply of EVs for General Motors. It's about 9% of their supply on the ground at the dealerships, but it only represents about 3% of their sales. So I think as we go through July and August, they're going to try and quietly sell that down and get that supply better aligned with demand.
Right. So then them pushing out production of the factory, the EV factory, like pushing that out in Detroit, et cetera, like this is good, right, for GM?
It is good, and it seems like it's being more acceptable to say those things, and that it's not, full throttle EV all the time. We saw the announcement from Ford about, trading an EV factory for a Super Duty factory. So it's starting to be acceptable to say, like, and that's what the business is, and it always has been, right? It's that trade-off. You have some models or business units or regions that are deficient in terms of profitability, and the question is, where do you make it up? And we've sort of moved to this period now where the EV business is the deficient business. Also for GM, the cruise unit was a significant loss in the quarter too. So you're how do you make that up? And for GM, Ford, even Stellantis, it's on the truck side of the business. And that's where it comes from. And it's starting to be acceptable to talk about trucks again.
So, Kevin, what's the updated consensus out of Detroit as to the timing of this transition to EVs? It obviously feels like we've hit a significant bump in the road and it's going to be delayed in this evolution. What's the current thinking out of Detroit?
Yeah, and I think there's been a little bit of a tailwind when you think about what's happening with the election in November, right? So I think it feels like in Detroit that the pressure is off, that we have to get to these targets by these dates, that there's a little bit more room to stretch it out and to say, hey, we can do the profitable things right now and work our way towards the EV thing and hope that those profit dynamics level out a little bit at some point. But it's really a little bit of breathing room, I think, that the industry feels like it's getting. And again, there may be some more uplift in November, depending how the election goes.
Hey, Kevin, really appreciate it. It's so fun to chat with you. Congrats on the new gig. Kevin Tynan, Director of Research at the Presidio Group, joining us on GM as well as Tesla, what to look out after the closing bell.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.